Good morning, everybody. It's Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly macro market and economic commentary for the week beginning today, October 20th, 2025. This presentation has been prepared by us for use with you. It doesn't matter if you are a financial advisor or an individual investor, you are still expected to make your own investment decisions. Nothing in the presentation should be treated as investment or tax advice. There's no recommendation for the purchase or sale of any securities. Everything is for informational purposes. Please consult your own advisors. The views expressed herein are mine and mine alone. They may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, despite an extended government shutdown, despite all kinds of worries, valuation worries and the like, earnings season is off to a good start, and equity prices continue to rise. Large, mid, and small, all up and all up substantially last week, with small cap stocks up about 3%. International markets were mixed, with large developed down about 0.2%, and emerging markets down about 0.25%. Interest rates are coming down. We have a Fed meeting. We're expected to see another 25 basis point rate cut on October the 29th. Until then, the aggregate bond index has caught a healthy bid. High yield remains very strong. Floating rate, of course, is floating rate, etc. So everything seems to be okay in the markets, just maybe not in the headlines. Moving along to the economic data, a lot of economic data we're not getting because it's produced by government agencies such as the Commerce Department, which, unless they are essential, are shut down during this period. Let's start with the National Federation of Independent Businesses Small Business Optimism Index. It fell a little bit, 100.8 down to 98.8. Respondents said they expect sales to go down, and their overall business condition outlook declined. Inflation pressures, though, they say, are still there, and a third of the respondents are saying they expect to raise prices, and doubts and uncertainty related to the economy continue. We then got the twin readings, regional Fed surveys, the New York State Manufacturing Index, along with Philly Fed. Starting with New York, rose substantially, minus 8.7 to positive 10.7. Line of delineation here is 0. Not uncommon to have a lot of up and down there. New orders turn positive, shipments turn positive, employment turn positive, and the overall outlook improved. So that's a little bit different from the prior reading from NFIB. However, just a few miles away, we have the Philadelphia region, and here it went from positive to negative. So no real conclusion we can draw from either. However, in common, business new orders rose for both. That was nice. Employment, it fell here but remained positive, and the outlook here actually rose. So mixed reviews from the two. The regular weekly claims for unemployment is delayed. That is from the Department of Labor. Retail sales, that is from the Census Bureau. That is delayed. PPI, very important because we're focused on inflation at the moment. September Producer Price Index delayed by the government shutdown. But there are many ways to get an idea of what's going on. I just grabbed 3 for you this morning. Let's start with the Cleveland Fed. It's a daily real-time CPI indicator. It should tell you the trend or where the CPI and PPI reports are likely headed. They say inflation is running about 2.99%, well above the Fed's target, unfortunately. And as you can see down here on the right, trending a little bit higher. Moving down to the center here, the Cleveland Fed also has a core PCE tracker, which is a very important one because that PCE is the gauge the Fed uses to determine whether or not it's meeting its statutory mandate of price stability. Came in at 287. That's a little bit better. Also still trending higher with the exception of just recently a little bit of a downdraft. We'd like to see more. Now, in the free, unfettered marketplace of trading Treasury inflation-protected securities, which imply a break-even yield, it implies an inflation rate based on the fact that you buy these bonds at a much lower yield than non-inflation protected bonds because you know you're going to get the CPI payment. Those are saying that 2-year inflation is likely more like 2.48. And here, I pointed this out last week, you can see starting to trend a little lower. So overall mixed. We have this. We're not getting CPI and PPI until later when the government reopens, but that's where we are. We then got a little pop in home builder sentiment. I guess that's because of the little bit lower rates. I'm not really sure. Still below 50. The line of delineation between home builders are optimistic and pessimistic. We're still well below that, but it did rise from 32 to 37. Present sales from 34 to 38. Future sales up a little bit. Traffic still miserable, but all up a little bit. Maybe anticipation of another rate cut here on October the 29th. Starts and permits remain very low as far as we know, because here another one that is impacted by the government shutdown. Same thing with industrial production and capacity utilization. Shutdown. This is a shutdown as well. Moving on. Here's the latest worry. You're starting to see this, and if you're not as deeply into financial news as I am, maybe you haven't noticed. However, I have, and I think it's worth starting to talk about and be concerned about. There's so much going right in the economy, and that's usually when something can come out of left field and get you, right? We've got massive CapEx as far as the eye can see. We've got foreign direct investment as far as the eye can see, including sovereign and private together. We have the one big beautiful bill, which is very pro-CapEx, meaning pro-job, pro-growth. We have households are very under-levered compared to historical standards. We have a transition away from an over-reliance on government borrowing and spending and Federal Reserve stimulus. Perhaps inflation is coming down. So what could derail all this? What could be the next COVID, the next credit crisis of '08 that comes out of left field? And I am starting to believe that there are building risks in something known as private credit. U.S. banks have exposure to this, so even though they're big public regulated banks, they have large exposure due to their investments of about $4.5 trillion. So this, even though this is, quote, private, and they have exposure to these non-bank financial institutions, which are making large amounts of loans to companies who are generally below investment grade. In other words, high yield, other words, junk, and they do this in a very much leveraged capacity when they do it. Private credit assets under management, these are funds that go to retail, some go to institutions, now up to $2 trillion. That's a 5x growth rate in the last 15 or 16 years. And the default rate on these remember, these are junk loans, are in the 5% range. Now, you remember these things, CLOs, collateralized loan obligations, CBOs, CDOs, where they took a bunch of non-rated credit and then tranched them and reassigned the first wave, second wave, third wave of defaults. So what you ended up doing was creating a AAA credit out of them, and then also creating what we call an equity credit, which was just like all the junk and all the defaults would end up going there. That was a contributor to the 2008 financial crisis. That's still happening today, not as much, but just the sheer amount of money that's flown into these and the amount of money that's flown in retail product pushed as safe, pushed as high yielding with low defaults. They talk about them being senior in the capital structure, which in my mind is just a mirage kind of a statement. Senior in a garbage structure is still garbage. What's something called selective default surged in 24. Selective default is when they don't technically default. Instead, they refinance in something called a PIK, which is payment in kind, which is basically you stop paying and you just accrue interest. To me, that's kind of a default. We also call it a soft default. Some people call it extend and pretend. We like to say a rolling loan gathers no loss. We could spend all day here with the vernacular around private credit. But the fact is, these have come up. The amount of retail, meaning unsophisticated money, has come up big time. And what I think a lot of investors don't realize is that even though you have a default rate of 5%, let's say, the rest, if you're not levered in, and let's just say you own the debt without levered, many of the other investors are. So maybe they have low cost access to capital at 4 or 5%. They're playing the spread, investing at 8 or 8.5%. When the tide goes out and there is credit stress, which is definitely building, plus we have this large maturity wall coming up in 26 and 28, But when credit stress becomes a significant thing in a market, it doesn't stay isolated. It usually triggers a broader de-risking cycle as investors cut their exposure, and then selling begets selling. And then when people see the value of their bond or their loan or their piece of debt go down, and maybe they don't fully understand what's happening, then that may beget more selling. So when that happens, investors start cutting their exposure, the liquidity evaporates, the risk premiums rise across the system, and that can have a contagious effect through all risk assets, whether it's gold, whether it's crypto, whether it's just equity markets. So, am I hitting the panic and the exit signals now? No, I'm not, but I'm seeing early signs. It could end up being fairly contained. But I do remember in 2008 very, very well when we started talking about this in the mortgage market, and Ben Bernanke, the then chairman of the Federal Reserve, famously quipped, "This is largely contained." We now know, of course, it was not contained. Regulatory structures are better today. Regulatory structures are different today. This is not as big a market as the mortgage market. Still, I remain concerned about this, and this is now moving up to one of my what could go wrong scenarios, and I want everybody to be aware of private credit risk. Okay, on to earnings. We have about 58, about a little more than 10% of the companies have reported. 49 have beat estimates, so that's exciting. We're happy about that. The average earnings surprise is just under 6%. Now, it's early. I don't want to make any conclusions until we get to 100 or 200 names. We'll do that next week's commentary. But we had been seeing surprises closer to 10, 8, 9% in recent quarters. So far, that seems a little bit on the low side. Not much in the way of economic data this week. Monday, Tuesday, Wednesday, nothing. Jobless claims Thursday, but unlikely because of the government shutdown. Existing home sales Friday, CPI also unlikely. The two reports from S&P Global, these are flash readings from manufacturing and services, both expected to be above 50. That's good. That shows expansion. New home sales expected to be horrific. Consumer sentiment for October at 55, looking at unchanged. And we have a lot of earnings this week, but just some notable names, some bigger household names, impact names: Coke, 3M, GE, Netflix, Tesla, IBM, and Intel. Thanks for tuning in. This is Slaying Bulls and Bears. I look to make the complex and complicated simple and sensical. I'm Herb Morgan. I'll be back to you again in 1 week.